The last in the series of our Chapter 2 learning modules will be to take a look at something we call horizontal and vertical analysis. The reason that we have classified our balance sheet and income statements is so we can use these two analysis techniques to better tell the story of the company. So first we're going to go ahead and talk about horizontal analysis. When we analyze financial statements over time, it's called horizontal analysis. The idea behind horizontal analysis is to analyze changes in the accounts occurring between years. So for instance, 2013 and 2012. We're going to look at the changes between the 2 years in the accounts and see if that might tell us a better story. To facilitate this analysis, we have to first do a dollar and percentage change are calculated for each item. So let's go ahead and take a look at what that formula is. So right now you're seeing the Bed Bath & Beyond specific items from their balance sheet. Here you see February 26, 2011, February 27, 2010. You see the merchandise inventory line item, so this would be the account. And you also see the line item for net earnings. So the way that we go ahead and we do the calculation is we take a look at the dollar change in the account balance, and that is current year minus previous year. That's the dollar amount of the account change. All right, so once you come up with that, you then take that divided by the, once you come up with that answer, you take the prior year balance. So effectively, it is current year minus previous year divided by the previous year. So let's take a look at that as far as the inventory line items. So the current year, you can see up here, is $1,968,907. You can see that right here. And we're going to take the change, the prior year balance, which is the $1,759,703. And the difference between those two gives us the dollar change. We're then going to take that and divide it by the previous year. So here's the previous year. And you get 11.9% change from year over year. So what this means is that from last year to this year, inventory grew 11.9%. That's what that says. All right. So if we go ahead and we want to do the same thing for net earnings, we take the current balance of the $791.33, subtract the $600,000 and change, and we end up with $191,300. You then take the $191,300 divided by the previous year balance, and you get 31.9%. So that means that the earnings grew approximately 31.9%. You can see that by doing this, that we have a better idea than the numbers. The numbers don't look that big, do they? We grew from 600 to 791,000. That's only $191,000. But based on what it was to this year, it's almost a 32% increase. Companies would take that every day. So in looking at this horizontal analysis example we just completed, we're going to look at the other analysis, which is vertical analysis, and then we'll work through an example or two, and then you'll be left to your own to work on some examples in some homework problems going through this. So let's go ahead and take a look. So vertical analysis compares financial statements of different companies and financial statements of the same company across time after what we call controlling differences in size. So what happens is when you're comparing companies of different size, it's useful to use these standardized statements. That is why we came up with the classified balance sheet or the multi-step income statement, is we can take a look at one company versus another and control the differences in size by doing this vertical analysis. Let's go forward and take a look. So vertical analysis is based on an account, okay? It's based on the total assets for the balance sheet and net sales or revenues for the income statement accounts. So what this means, different from horizontal, is for the balance sheet, you're going to use the account balance divided by the total assets for every single account balance. For the income statement, you're going to use the account balance we're wanting to measure, just like here, but you're going to divide it between net sales and or revenues. The two calculations for vertical analysis on the balance sheet and income statement are as we show above, and students have a difficulty sometimes remembering what it is they're to divide by. So the key is for the balance sheet, you divide by total assets. For the income statement, you divide by net sales or revenue. Often when we use vertical analysis, we call it common sizing the financial statement. So what it does is we're going to take a $1 billion company and compare it to a $1 million company, and by doing that, the way that we do the vertical analysis based on assets or revenue, we then common size it, and their percentage could be the same on an account as the larger company, just because of the way we're doing the calculation. So we call vertical analysis common sizing the statement. It is a statement in which all accounts have been standardized by the overall size of the company, and it allows investors and creditors to determine the importance of each account to the overall company. We're going to go take a look at how to do that. So here, again, using our Bed Bath & Beyond example, we have the 2 years, we have merchandise inventory, we have net earnings, we have net sales, and total assets. So remembering that the formula for vertical analysis is the account balance. In this case, it's merchandise inventories. We're going to divide anything on the balance sheet by the total assets, which gives us 34.9%. So what this says is that the inventory represents almost 35% of the assets. The prior year, it represents 34.2%. So you can see year over year, there really wasn't much change. When we look at the earnings, though, we would take the net earnings, because that's an income statement account, divided by net sales. So again, balance sheet is the account by total assets, and income statement accounts are the account divided by net sales all the time. So in this case, if we take the $791 and we divide it by the net sales, we get 9%. If we take the $700 and we divide it by that, we get the 7.7. So you can see year over year, we increased about 1.3%. Still not terrific. I mean, still not a huge increase, but an increase nevertheless. So every time that we do this, we use this formula and just plug in our information, which you will have an opportunity to do on your own. And what this tells us is that even though the inventory grew slightly, we were able to generate more sales. This is very important, that the numbers sometimes might not be that large, but it could be a huge increase, or if the numbers are too small, it could be a huge increase. It's because we're common sizing the statement that it becomes more relevant. We can also then go look at other companies. For instance, if their inventory is growing, what percentage of the assets is it? Is it a third of the total assets? Therefore, is that how I'm using my cash? We can also say if my earnings increased by 50%, then why? I would be a company I would want to go look at why that increased. It tells a more complete story, and if you don't know the story, then it alerts you, depending on the percentage changes or the dollar changes, to go look further into the accounts by using the notes to the financial statement, which we'll cover the next time we meet in class. So let's go ahead and practice. So at this time, go ahead and turn to page 45. You will need a calculator if you're following along or you're wanting to help me out while I'm going through this. So we're going to be on page 45, and we're going to be taking a look at number 8, exercise number 8. It says, conduct horizontal and vertical analysis of gross profit. Was the company more or less profitable in the current year? Do both horizontal and vertical analysis indicate that? For your calculations, round percentages to 1 decimal point. I will tell you that Cengage, when you're doing your homework assignment, can be very fickle and students get extremely frustrated. Make sure you're using the calculator appropriately. If it tells you 1 decimal point or 2, make sure you do that. Sometimes you have to play with that 0.1 to get your answer to be correct. I think I've removed the longer problem, which gave the students more frustration last year than knowledge. And so hopefully that won't be too bad for you guys this year. So it says it wants the vertical and horizontal analysis of gross profit. So let's start with horizontal. The horizontal formula is current year minus previous year divided by previous year. So if we take this out and we're doing gross profit, okay, we would take the gross profit from the current year, which is 1787, minus the previous year gross profit, which is 1252, divided by the previous year, which is 1787. So if we go ahead and do the math on this, we take 1787 minus 1252, 1787 minus 1252 gives us $535 divided by, so that was the net dollar change, divided by 1787 gives us a percentage of 29.9% if I'm carrying it 1 decimal point. So the $535 million of Smucker's gave us a 29.9% increase in gross profit year over year. What this means is that we probably sold more. So if you looked at it, we did sell more, but our cost of goods sold didn't change as much. And so that means we have more money to spend on other things, on our operating expenses, such as advertising, marketing, and so forth. Okay? Now, let's take a look at vertical analysis for this same problem. Vertical analysis is always the account balance divided by, if you're on the balance sheet, it's divided by the total assets for balance sheet, or the income statement, it is based on net sales or revenue. So if we look at the account balance for the current year, so we're going to do the current year, and we do the current year, we have 1787 divided by net sales of 4605. If we look at this and we do the math, we have 1787 divided by the current year net sales of 4605. Gives us 38.8%. If we wanted to do the previous year, we take the account balance of 1252, and we're going to divide it by 3758. So if we take 1252 divided by 3758, we get 33.3. So what this says is the gross profit grew about 5% from year over year. Okay? When we're looking at the vertical analysis of the gross profitable. So it says which company, if we're looking at this, was the company more or less profitable in the current year. So in our particular case, the company was more profitable in the current year by 5%. Okay? Do both horizontal and vertical analysis indicate that? And the answer would be yes. All right. So what you're going to do on your homework assignment is you're going to go ahead and take a look at some other homework. But before we do that, I want to do, okay? And that exercise is on page 45. Oops, that looks really bad, doesn't it? Let's erase that. Okay, page 45. And I want you all to take a look at number 7. Okay, number 7 says do the horizontal and vertical analysis of inventory for the current year and round the percentages to 1%. So at this point, I'm going to have you pause your video and go ahead and try and work this problem, and then we'll come back to see if we get it. Okay, let's go ahead and go through number 7 on page 45. This particular problem is giving us financial statements for this company and asking us to conduct the horizontal and vertical analysis of inventory for the current year. And so to do the horizontal analysis, we take current year minus previous year divided by previous year. So in this case, it would be inventory of 66,540 minus 63,180, which is this is the previous year, current year, divided by 63,180. And if we do this, we get, let me do the math, 66,540 minus 63,180 equals 3,360 divided by 63,180. And we get, it looks like, I think 5%. I'm looking at this correctly and I did the math correctly. And then if we wanted to do it for sales, so this is for inventory, we wanted to do it for sales, we would do 190,405 minus 201,450. So right here we can tell sales declined. 201,450, and we would divide that by 201,450. And if we did the math on this, we would see 190,405 minus 201,450 gives us a change of 180. No, that's not right. I did that wrong. So let's go back and put that in again. 190, I hate that, 405 minus 201,450 gives us $11,045 divided by 201,450, and we get a decline of 5%. So what this shows you here is that sales declined 5%, but inventory increased by 5%. And that makes sense, right? Because inventory is what you sell to make sales. So if you're not selling your inventory, then your sales would decline and inventory would increase. Now, if we were going to go ahead and do vertical analysis, we're going to take, and we wanted to do it for inventory, be 66,540 divided by total assets of 270,450, which gives us 66,540 divided by 270,450, which equals 24.6. And remember that the vertical analysis is the account balance, which in this case is inventory, always divided by, when it's a balance sheet account, always divided by total assets. So if we were going to look at the previous year, we have 63,180 divided by 240,680. And that's going to show us that inventory is approximately 26% of our total assets, roughly 26.2 or 46.3% of our assets. So technically, inventory declined as a percentage of our total assets. If we were going to do the sales vertical, we would do the 190,405. So it's 190,405. Divided by the total sales, which in this case would be 100%. So in the information that they gave us, we can't do the vertical analysis. we can only do it for inventory. If we were going to do it for sales, we would need to have another account on the income statement. So at this point, we're not going to do a vertical analysis for sales because it would be the account divided by the sales, the total sales. So you'd get 100%. All right. So I think this gives you enough information to be able to attempt the homework assignments on Cengage. And I'm looking forward to any comments that you have when we come back to class. Make sure you keep track of any of your questions. Either raise your hand, send me an email, or go ahead and put them on the board if you want them covered in class. Happy travels!